Welcome back, traders and investors. We have Reverend Emmanuel Lemelson on the line, founder and president of the Lantern Foundation and chief investment officer of Lemelson Capital Management. Reverend, how are you doing today?
Good, thank you. How are you, Joel?
We're doing good here. Markets are still trading up this morning, so trying to get back to new all-time highs. And that just kind of leads me to my first question. The market's had a significant sell-off over the last few days. We battled back here. I know you're an individual stock picker and, pay attention to the overall market, but just getting through the earnings season here, the rebound that we have, do you think the market's stabilized and ready to go back up to new all-time highs, or think we have some work to do on the downside?
Well, it's certainly possible, Joel. It seems to me that nobody really knows where markets will head tomorrow or next week or even next year, but there are things we can know when we look at the historical data. We can look at things like margin debt and its relationship to prices in the market against historical averages. And the current environment looks awfully expensive. It's not terribly unlike 1999 or 1929. And, these things can't go up forever. You never know when they're going to go down. But I think investors should be very cautious and very, very much so aware of those things. I'm not convinced that earnings and economic activity really is connected very closely now to these rising prices. It's starting increasingly looking like a real speculative bubble.
And I guess you could throw 1987 in there, too, if you're talking about...
You certainly could, absolutely. Of course, asset prices recovered quickly in 1987, unlike the late 90s and early 2000s, or the early 30s for that matter. I think some of the things we can observe there, a little bit more tangible, is just what's sort of the general mindset of these groups of participants in public markets, and have they begun to believe that prices can only go up? Do they believe that no matter what happens tomorrow, prices will be higher? Because that's really the definition of speculation.
Correct.
And speculation is a fallacy, right? Because nobody really knows what's going to happen tomorrow.
Great.
God knows, but we don't know.
That's a great point. So, boy, the geopolitical events have really been it really took a toll on the market last week. Took the market down, and then when it looks like the Russian troops are backing off from the border, brought us right back up on Friday. How closely do you follow the geopolitical events?
Well, I think it's important for everyone to follow them. Absolutely. Geopolitical events can precipitate a change in sentiment, absolutely. But we don't necessarily know the outcome, of wars and so forth and its impact on prices, per se. Speaking now about these previous, pullbacks, noteworthy pullbacks in markets in history, it was geopolitical unrest and what eventually led to wars actually helped pull us out of that. There's no way of knowing, but people in Europe can't be very happy, and, in the U.S., we should be very cognizant of the fact that Russia is behaving in a very aggressive way in Ukraine. And, these people are suffering. In other parts of the world, in the Middle East and Israel and Palestine and so forth, it's very tragic. And in Iraq, probably not enough news coverage of it, but what's happening with ISIS and the Christian communities there in Iraq, a whole slew of martyrs being made. And we need to be aware of these things. The world is full of turmoil. We don't always see it in our country, in our backyard, because, frankly, we have a $600 billion military budget. Which isolates us, but it doesn't mean that there isn't turmoil. There's always some turmoil in the world, but it seems like there's an awful lot of tragedy and innocent loss of life right now.
Yeah,
we have to pray that ends.
Yeah, we do. The Arab-Israeli conflict has only been going on for a couple thousand years, so
that's a very good point.
So there's probably going to be no quick resolution to that. So we'll just have to see what happens on that front. So you mentioned it earlier.
More specifically, though, I think Christians of every flavor. Really, all the different denominations should really be engaged in a conversation and dialogue and unity about what's happening in Iraq, which probably isn't getting enough coverage. This is a very ancient Christian community that's being ruthlessly persecuted and openly persecuted. But we should have more of an open discussion on that. You're right about Palestine and Israel and so forth. What's happening in Iraq? This shouldn't be happening in our modern times. It really shouldn't. And it ties in some ways, of course, to the Kurdish issue in Turkey and issues of religious freedom there, and what's been ongoing but subtle religious persecution in Turkey for a very long time of Orthodox Christians. So something to be aware of.
Certainly. And I think you touched on this with your opening statement. The earnings season here, it's kind of seen, a lot of stocks have gotten nice pops. In fact, several stocks
Sure.
have traded much higher in the after hours or pre market trading and then given back all those gains and kind of, and some of
Sure.
them even ended up in the red. My first question would be, do you pay attention to the after hours of the pre-market trading for price, for price action, and would you also, agree with that overall statement that it's kind of been selling the pops here, on the good news in the earnings season?
Yeah, well, I think those expressions and that terminology is really commensurate with trading activity, which I couldn't really speak intelligently to. If traders have some edge or some knowledge, I wouldn't be aware of it. I mean, I think the soundest thing you can do with your capital is try to make wise investing decisions. Prices in the near term, whether it's in the pre-market or the post-market or even tomorrow or next week, aren't usually relevant in the long run. Really, wealth creation occurs over a long period of time and usually involves owning a piece of a great company which is going to produce consistent earnings with a first-rate management team. I think when you get into these shorter and shorter slices of time and these smaller and smaller permutations in price, it looks an awful lot like a losing proposition when it comes to capital allocation. So my thought would be try to stay away from watching that stuff so carefully. Get back to trying to understand where you can put your money, where it's going to be first and foremost, where the principal is going to be safe, and where when you're handing your capital over to a company, they're going to take it and they're going to produce better than average results in terms of their return on their equity.
Okay, so let's go to your Ligand pharmaceutical position. Definitely, since the last time you were on the show, it's definitely working its way in your favor. Has anything changed in the fundamentals for you to reevaluate your analysis?
No, absolutely not. When we published the initial report on June 16th, shares were trading around 69 just before that report came out. By August 1st, they were under 50. I mean, they traded around 47, 48. So the company had lost about 35% in about 6 weeks. The company recently reported its Q2 earnings, and the way they presented those earnings really deserve close scrutiny. I mean, they talk about an 11% increase in revenues compared to a 9.6 million figure for the same period in 2013. But when you back out non-cash items, it's really not what's happening at this company on the top or the bottom line. There was an upfront non-cash licensing fee which was received by the company from PG Therapeutics. When that's backed out, the company's revenues were actually declined year over year. And if you look at all of their major revenue-generating programs, they're down across the board. So the result was the EPS had actually fallen 76%. But reading the company's press releases, that wouldn't be immediately obvious. There's a lot of talk also, about their technology platform, their Captisol program. But if you look at that closely, it was actually down $500,000 at 13% year over year. And, these things aren't immediately obvious to the average retail investor reading these press releases. There's no statement of cash flows. And the company is consistently using non-GAAP earnings measures. Non-GAAP measures have a place when a company has exceptional one-time items to report, but they really shouldn't be used on an ongoing basis as Ligand has done. And if you look carefully at the reconciliation between non-GAAP and GAAP, really what it's doing, it's really only cloaking one thing, and that's awards to management. So, for example, the net income from continuing operations dropped from 3.7 million in Q2 of 2013 to just 1.5 million in 2014. This is a drop of 57%, but if you take into account the company's ongoing dilution, it's actually a drop, like I said, of 76% of EPS. At the same time, contingent liabilities increased to 147%. There's 800,000 missing from the income statement in the way of its adjustments for investments. This is a company that, by no definition, can you say that its fundamentals have improved. They've only declined. And while net income attributable to Ligand common shareholders fell by this 53% in the first half, from 7.6 million to only 3.7 million, management stock awards actually increased 100% to 5.1 million, which is 27% greater than the company's entire first half 2014 earnings. So, getting back to what we can know and what we can't know, we don't know the price of Ligand tomorrow or next week, but we do know what the company's performance has been year after year, and we know what the performance has been recently. So I think in terms of understanding, safety principle and the sort of proverbial Germanian margin of safety, you're talking about a company that, if the definition of insolvency is liabilities exceeding assets, and that's the legal definition. In practice, people refer to an ability to pay bills, but when you back out intangibles from this company before their August 4th release, they were technically insolvent. If you're looking at, removing these intangibles, which are questionable to begin with. By August 4th, the company, releases its earnings. They had just 21,000 in equity to buttress a market capitalization of almost 1.2 billion. That should be very scary to a common shareholder. And in that August 4th report, it concluded with what wound up being a very prescient statement that common shareholders are not the same as bondholders or other forms of security holders. And you're probably aware yesterday the company released an announcement that they would be doing a bond offering for $225 million. This was a company that enjoyed 6 days of solvency. If they're going to take on $225 million in your debt, there's going to be a debt service associated with that, and it's going to be very hard to refer to the company as solvent, even if you include the intangibles. If that coupon's 5.5%, you're talking about almost $13 million in debt service. In the last 12 months, the company only earned $7.5 million, all of which, of course, was consumed by stock worth to management.
Well, no,
I would say to the average shareholder in the most academic and sophisticated terms I can think of, run, Bambi, run. That's the only thought that comes to mind for the common shareholder, because things like that start to look a lot like the Titanic. And you read these press releases carefully, and you have to ask yourself, why is the company doing press releases? I mean, do you think it's for institutional holders? I don't think so. I mean, these guys have a direct line to the CEO and the board of directors. Those things are for retail investors. And if you read it carefully, I mean, it looks a lot like institutional holders trying to get out of the common equity. 50 million, almost 47 million of that bond offering is going to be a private transaction.
Wow.
I guarantee you that's not somebody at home with their Scottrade account. And those are going to transactions that are going to take place outside of the public markets. I mean, if you've got 280 mutual funds that own the stock, and some of these guys want to get out, they can't do it on an issue that only has 300,000 shares traded a day.
Correct.
These things need to be negotiated in private transactions. And you have to ask yourself, why would a company with 21,000 in tangible equity, why would they take on 225 million in debt? And then this extraordinary 200 million share repurchase program. But because they're convertible notes, I mean, of course, that in itself would lead to tremendous dilution in the future.
Wow.
If they weren't in fact converted. But who's going to sell into that tender offer? Presumably, it's these large institutional holders. I mean, we know at least 50 million more or less is going to be an institutional holder. And why do these guys want out? I think the average retail investor needs to be very cognizant of that. Ligand is attracting a certain type of investor. I mean, people who would buy a lottery ticket. They want to get rich quick. They like to trade.
Right.
And if you read these press releases carefully, that's really what they're selling.
Well, no one can accuse you of not doing your homework. That's for sure. You just ripped through that financial statement with a lot of knowledge. So, target price for LGND?
Well, you never know a target price because you never know what the market's going to do. But I think you can certainly delineate between price and value. And price, to use Buffett's words, of course, price is what you're paying, value is what you get. If you're getting 21,000 in tangible equity and you're paying 1.2 billion for it, does anything else really
do the
need to be
math?
said?
Right.
I mean, and a company that they'll tell you the business is great and they've got all these great royalty programs and they're all these press releases. I mean, I can't even keep track of the press releases anymore. But if you look at the financials, this thing is going straight down. They talk about beating guidance? You're talking about a company that lost 76% year over year, and what's supposed to be increasing sales on their key capsule technology program and Promactazole and so forth. Those things are going to go away. I mean, people say, well, Promacta is used for ITP. Well, no, it's not. I mean, if you look at the annual reports, the company describes it very specifically and has the indication. The company also talks in their annual report about going concern risk. If you want to increase going concern risk, just add in the 225 million in debt.
Right.
7.5 million in earnings. That should be very, very scary.
Okay, and just finally to end the broadcast, and this is kind of the way you and I became connected through an article that I did on WWE, and that was after you announced your short position and disclosed it to the public. And then when I had you on the show, it was wallowing at the $10 area. Now, correct me if I'm wrong, but I thought you said you were nibbling at it on the long side. Did you, and are you still holding?
Yeah, we took a long position after we covered our short position in the $10 range. And that's done very well. I mean, I think it's up 20% or something since that time. So
still holding on?
WWE, yeah, absolutely. I mean, WWE has value, there's no question. It's not a situation like Ligand. You have two situations where management have both perhaps not been as careful with their fiduciary responsibility to investors as they should have been. When when the truth emerged, this was really a heavily promoted stock. I mean, there were 5 law firms invested in the company. And in hindsight, that made perfect sense to me. Hindsight's 20/20, right? With Ligand, you have a promotional CEO, and They're promoting the stock heavily. Maybe they believe in it. We really can't judge. But the point is that if the truth emerges that this company is not going to ever have earnings that can justify this market capitalization, there's going to be a lot of angry shareholders. I mean, they're going to feel duped. I mean, here you have a company that had real value. It was just overpriced. And then a real monopoly and a long enduring franchise that actually made money consistently for a very long time. On the other hand, you have nothing but a company that's lost money over a very long period of time. So that company is worth holding. I mean, there's real value there. And I think the stock price appreciation is certainly justified, especially since the company, I mean, heeding really the call of investment. We call for changes in the management team. The company recently announced they laid off 7% of the staff. I mean, this is a management team that's listening, and I think that's really important. They've kept the dialogue open, and they deserve a lot of credit for that.
Okay, well, thanks for coming on today, Reverend Emmanuel Lemelson, founder and president of Leonard Foundation and chief investment officer of Lemelson Capital Management, talking about a couple of his positions. Thanks again for coming on, and we hope to have you on again soon.
Absolutely. Thanks for the invitation, Joel, and really enjoy your show and the site as always. You guys have done fantastic work.
Okay, thank you very much.
Thank you so much. All right, bye-bye.